Hello, welcome back to WINFXTRADING YouTube channel. In today's video, I'm going to show you how to take $50 to $50,000 plus power of moving averages to trading BoomCrash indices. Okay, this is the topic. This video will not take much time. I'll be going to the MT5 to start the real teaching of this. Okay, make sure you watch to the end. And you shouldn't just watch few percent, few parts. Let's say some people just watch first 2 minutes, first 3 minutes, and skip. That is not it. If you want to be successful and wealthy, ultra wealthy in life, you should be serious and pay a lot of sacrifices. Okay, I'll be shooting there. I'll be shooting on the real MT5. I'm back here. So let's open cash 1000. This is cash 1000 index. Make sure that the time frame is the H4 time frame. Then you have to click on the F, which is the indicator, the moving average. Set it to pure 20. Everything should be default apart from the color. You can change the color, but I prefer yellow. Click on the plus again, back to moving average. The pure should be 200, and the color, every other thing default color, set color to green. So that is it. This is the only indicator we need. Okay, the zone level should be the second to the least zone level. Okay, it's good. Second to the least zone level is good. You see, it will take you time to get a signal, but once you get that signal, you are going to make massive profit. So we assume you have $50 account. So how in reality will you take it to $50,000? I will show you. It will not happen in a day because the signal might take some time. Maybe you will get 2 signals in a week because you have to search across all the boom and crash assets. We have 6 of them, and then you get signal from them. One signal, you make massive profit. One signal, you make massive profit. Okay, but it will take time to get a signal. But once you get it, you are going to make massive profit. Okay. So let's continue. If there will be some exception in this strategy, I will make it visible. I will bring it to light towards the end of the video and give you solution to that. Okay. I don't want to be, going into that now. Let's talk fact. Let's talk fact here. Let's talk fact here. Let's talk fact here. We are waiting for crossing. You don't need to know if the market is trading or ranging. We are just looking for crossing, irrespective of the nature of the movement in the price. We are looking for crossing. I don't care if it is trending or not trending. Now I'm just looking for a crossing of the moving average 200 upon 20 or vice versa. Okay. I see one here. Let's see in the most recent in future. I see one here. There is one crossing here. There is a crossing here. Okay. And there is another crossing here. So we shall be looking at 2 of them and see which one is viable. Okay. Which one is viable. Okay. Which one is going to be feasible or work. Let's see. Okay. You see, I'm going to add a little bit price action to it so that it will work, because indicators are lagging. They lag. They are phased out. Like they have phase. They're out of phase. There is this phase difference between indicator movement and price action movement. So if you are seeing signals from indicator, those signal has already happened. That means if you trade such signal, you see losses because the actual signal has happened. They're out of phase. There is a phase difference, okay, of certain degrees. Okay, so that's why I will introduce price action to eliminate the phase error, the differential phase error. Now you're actually waiting for a break of structure, right? You should know what structure is. If you don't know what structure is, I don't know what I will tell you here because this is outside this course, but I will give it a little bit highlight. A structure is a shape like inverted V, M, W, something like inverted U or U shape. They are just structures. So you can see the market goes up here, retraces into this zone, forming the inverted V, go up again, forming N structure. This structure was broken, a retest was made. So when you see this crossing, a retest was made, right, to the broken structure, that is the signal. You are going to trade in the direction of the breaking. You are going to trade in the direction of the breaking. So you are going to buy cash 1000. You should put your stop loss. You are not going to any other time frame. You are remaining in this time frame. You should put your stop loss below the crossing. This is where the crossing happened. So you put your stop loss below it. In order to save money, in order to have more lot size, in order to use big lot size, I think you should go to lower time frame. Then when you notice this type of behavior, go to lower time frame. Let's mark here, let's mark here, let's mark here, let's mark here. This is where this is the crossing, right? And then this is the zone where the break can happen, somewhere here. I'm going to be going to lower time frame to see where we can possibly put our stop loss. Had we have such opportunity in the past? So so look at this low here. Look at there is a low. First of all, you go back to henceforth, and mark a possible low you can see. Mark a possible low you can see. So I'm going to mark it with this horizontal line. This is a possible low I can see. So let's go to lower time frame and see how we can leverage some good low. Okay. So we see this low here, but we can possibly now where do we expect to enter? Let's go back to H4. Where do we expect to enter this market? We actually need to enter this market upon retracement. So we are entering this market somewhere here. So let's change the color to green as the entry signal. Okay, so let's go back to M15. Let's go back to M15. Let's go back to M15. Stay tuned, stay tuned. Don't just skip. If you really want to make it here, you have to stay tuned, okay? If there are exemptions, because all these celebrity video have issues at the end. So I'm gonna make that, it's not premium. So I'm going to talk about the exemption so that you know what you're doing. Okay, everything will have to work, okay? You see, we are entering here. We are entering at that green price. If we are entering at this green price and we are putting ours, like if we were in H4, our stop loss should have been enter here and put stop loss here. But I want to minimize the stop loss. This is over 114 pips. I want to minimize it. So that we use a small stop loss, or even if we are going to use this stop loss, we are going to divide our equity into a parts and use this one, and then the other part we use one part on this stop loss and the other part on another stop loss, so that we get high risk reward ratio. So here our stop loss should be here if we are in H4, right? But we still did another stop loss minimization, so that we can spend less in order to enter this trade. So here you check where the moving average cross in the M15 time frame. They actually cross here. Okay, there is a crossing here. Now there is a crossing here. Actually, we are. It will not make sense to consider the crossing that has already happened here. Okay, it will not make sense to see the M15 crossing, because we actually based on H4 crossing. Now look at what you are going to do. Check where we are entering, then check the nearest low to the entry. So this is the nearest low. Now check the moving average 200. This is it. Then check uh check if there is a low below it. The only low below it is this one. like the most nearest low below moving average 200 is this one. Now let's test. If we are putting our stop loss below this low, we shall be risking 93 pips. So we have a reduced stop loss instead of risking 114. Okay, but it's still almost closer. So what we need here is when you notice this low here, measure the distance of this low to the entry, which is 27, and then measure that 27, that peep, that peep from the entry to the low. Measure it from the low to another low. Okay, so measure 27. So you can put your stop loss here, so that the total risk will be how much? We'll be risking 54 times 2, like 54. We'll be risking times 2 of the distance you measured before from this low to the entry. So you'll be risking 54, 58, yeah, 50, it's supposed to be 54 pips, 54, because 27 times 2 is around 54 pips, instead of risking 144. Okay, so there is a gain in risk reward here, like massive gain. Okay, when you risk, if your normal risk reward should be 1:2 on risking 114, then when you risk 54, your risk reward will suddenly and exponentially grow to 1:4. Are you getting it? So that is it. So you can, if you have $50 account, you can risk $25 here. You can have two stop losses. You can risk $25 at this stop loss, and then risk the remaining 20. I'm sorry, $25 at this stop loss, and risk remaining $25 at this stop loss. If this one is taken out by massive drawdown, this one will not be taken out, and so this one will recover the loss and still give you profit, because if you go to hedge for, our target is what, towards the end of the screen. Yes, you can now go to this zone level, because the price will actually approach the end of the screen. That's how the reef work. They relate with the screen end so much. So imagine we have a kind of serial risk reward, because we are going to add up the risk reward. Here we have a take profit of 624. So I'm going to open my calculator. So 624 divided by first 114. The first one is giving us 1:5 risk reward ratio. Imagine. Okay. When we use a very maximized stop loss, huge stop loss, okay, we still have 1:5 risk reward ratio based on end screen criteria of taking the profit. Now, when we remember this number 5, so 5.47 is the risk reward. Okay, remember this number. So when we are going to be using 54 as our stop loss criteria, or a minimized stop loss, so we have 11.5 risk reward. So the total risk reward will be 11.5 plus 5 point something, let's say 5.5. Okay, so we're having 17. Okay, depending on the distribution here, we are risking how much in dollars? $50 account, $25. Here we are risking how much? $25. We should have actually say, okay, since this one is more risky, let me risk $15, and this one is less risky. This 5.5 is less risky. Okay, so let me risk $35. Okay, so depending on how you distribute your equity, this is called hedging. One is more of arbitrage, hedging or arbitrage. One lost, the other one will recover. One lost, the other one. If any of these, even if the one that is like the one that will be lost is let me remove arbitrage here. Let's call it hedging. The one that is going to likely lose is the one of high risk. Okay, which is this one. Then if it is lost, then it becomes zero. We will still have $192. You invest $50, you are having $192. Imagine. So anyway you see it, this strategy is very powerful. Now you will say, but we have not hit $50,000, but we are hitting around $400 when all the position hold, and they are likely going to hold. As you see it, it hold. You are not praying to lose one anyway, but if once come to worse, you are making $192 plus, right? Now let's imagine the worst scenario. You make this, then you do what? You have to come back and see, wait for another signal. Okay, you wait for another signal, wait for another signal. um let's check this. Let's check this. Wait for another signal. There is no signal yet. We check another asset. Crash 500. We are looking for another signal. I don't know the stop loss you use. Though in this video I didn't teach you how to get the stop loss, but once you know what you want to risk, I'm sorry, the loss size you use. I don't know the loss size you use, but once you know the amount you want to risk, and the amount of stop loss pip you want to use, and the amount of money you want to risk, the loss size should be the amount of money divided by the stop loss pip. Okay, here we are risking 114 and 54 differently, and we are distributing our equity like $25 or $15, $35. Just divide the amount of dollars by the stop loss pip, you get your loss size. Now as your equity increase, we are going to multiply your loss size by the rate of the increment. Simple. There is no too much analysis here. Like we are using worst scenario situation. We have to use worst scenario. Like you have to use worst scenario condition. Okay. 192 is the is the least profit we can make. Is the in a worst condition, this is the profit we can make. So you are going to say, what is the relationship between $50 and 192? Now look at it. This is the relationship. Okay, that's where first exponential processes or first exponential equation we apply. With the relationship is that the profit is 3.84 times the what the investment, the initial investment, like the equity, initial equity, so 3.84. So in the next trade we shall be using total of 3.84 watts loss size, but then it will vary. There will be some variation depending on the stop loss pips, depending on risk management, but it should not go beyond this loss size. Yes, because we are risking all the equity, we are risking all the money. There's nothing like risk 10%, 2%. This is the exponential process. You don't taking $50 to $50,000 is not something you do. Like you need a short signal, and then you leverage as much as you can for this thing to come to reality. Okay, so I will go and look for another signal. There is a crossing here. This is a cash 500. There is a crossing here. We see a crossing here. You can see a crossing. There is a break of structure. There is a break of structure here. Okay, and any structure was broken, or let's call it multiple M's. If you follow me, if you are watching this video carefully, you notice I've been saying this: up here, down here, up here, down here. So this is a kind of M structure, because it goes up, come down, goes up, then goes up again. So it's changing from M to W. So this is W, multiple W, a kind of W structure, broken. Okay, but there is no retest to this W. There is no retest to this W. The market is moving impulsively. Now let's pull our Fibonacci. That is where Fibonacci will be useful when there is impulsive movements. We look for where it started and where the sellers, because the impulse is by buyers, where the sellers are entering. They also actually tested Fib level of 23.6. Let's mark it. They tested Fib level of 23.6, but I don't trade that. These are going to be fake signal. I prefer marking Fib level of 38.2, fib level of 50.0, fib level of 61.8. Now when price adhere to this mark fib level, uh Okay, let's add it again. 61, yeah. 50. Okay, yeah. Then let's delete the fib level. Let's delete the fib by 2. Okay. Now, as price is up, like definitely price will retrace to these fib levels, any of them. But as price react to any of them, I will test for um, change of trend. If there is no change of trend, then it might come back to 50.0. If there is no change of trend at 50.0 at some lower time frame, it will come back to 61.8. If it breaks 61.8, it have changed trend. The signal will not hold again. The buy signal here will not hold again. So you have to look for another trading strategy here. Okay, but it's not our fault. Had it been it retraces quickly, had it been it retraces quickly, we should have taken this opportunity. It's not our fault. Market condition varies. You have to be flexible. Had it been it retested here, we should have bought here. Yes, we should have bought here. Then our stop loss should be below here. Okay. But then to get, as I told you, you have to hedge your trading to get some minimized stop loss. Even though you will be trading this maximized stop loss, to get some minimized stop loss, you need to go to lower time frame. You need to go to lower time frame, right? And do that. I've shown you. I don't want to go again, but you have to do that. Use the idea of getting the stop loss, reduce by measuring from your actual entry to some to most recent low and all of that. And maybe if you are watching this video up to this point, I can help you out. Let's do it. Let's do it so that you learn more. So this is with the crossing here, and uh this is entry. Uh, the retest should have happened here, and then let's mark the entry. Let's delete the fib too, because we have already assumed that the retracement wasn't like the retracement actually happened. The market wasn't so impulsive like that. So yeah, we have change the color, let the color remain green anyway. So we definitely will be placing our stop loss below the crossing. So let's change it to green to red. Okay, now let's go to 15 minutes time frame. Let's go to 15 minutes time frame. Let's go to 15 minutes time frame. Okay, let's go. Let's minimize a little bit so that we can see what you're doing. Okay, this is the area of entry. This area here. This is we are entering here. So before we enter, is there any low that is outside moving average 200? No, there is no low that is outside moving average 200. But our maximized stop loss is this one. Okay, when I use low, I use it because we are looking for buy signal. If you are looking for sell signal, you are looking for highs. Okay, so maybe we reason that maybe in boom market, this video is taking much time, so I have to rush things here. Okay, so you measure the distance from this low, any other possible low you can see that is either closer to moving average 200 or outside it, which is this one. And then measure the distance is 75 pip. So you measure another 75 pip. Measure another 75 pip. Now it's giving us a maximization, not minimization, because it's now outside the moving average. It's now outside the stop loss given at H4. So in this case, we shall be using this stop loss here and then this one. So that is it. You see, this is a mathematical something. You need to be mathematically inclined for you to understand it. If you are smart enough, you should have a record and writing down things. Maybe you are not going to go and learn it yourself, okay? I'm just opening your eyes, okay? So this is it. We are risking 21 pip in one of it. Like we are risking from here to here, we are risking 64 pips, 75 pips, and then we are also risking 101 pips. So you divide the equity in the ratio, okay? But to simplify matter, if this idea of dividing is hard for you, and you like is hard to you, then all you need to do is just use the average value, use the average value with that is where statistics will come in. 75 plus 101. You see, it's more of mathematics here. It's more of mathematics here. Okay. So it's 8 pips. Just measure. You are going to measure here. You're going to measure remaining the 15 minutes time frame. You're going to measure here, the entry here. Measure 88, 88, 88, 8. You are entering here. Okay. Now, 88. This is 88. This is 88. Now, we have our 192 worst scenario. If your equity is not actually this but is bigger than this or less than this, you have to calculate your stop loss size accordingly. I just use a theoretical worst scenario. This is not practicalized, this is not in reality, but you, when you are trading, you should know what you are getting. Okay, so you have to use that. You have to risk or divide it by, you know, divide it by the pip. So we shall be using total loss size of 2.18 in order to remain in this trade. Okay, we are using total losses of 2.18 in order to remain in this trade. Now, if we're able to enter this trade, now, enter here, we should have caught, because definitely we are going back to henceforth and we are targeting the end of the screen, because that's how the real behave. We should have caught this move 229 pips, and that will be 229 by 2.18. We are making close to $500 plus our initial worst scenario equity, which is 192. Now we are having $691. Okay, you repeat this process over and over again. Maybe it might take you up to a few months for you to hit $50,000, but that is, you remember, you depend on moving average, so that's why it's taking time. Okay, that is the power here. Okay, before I end this video, we should be actually going to boom market. See, we need a self signal. Let's see if we can get a self signal here. Where let's reason boom is a boom 1000. You see, the trade I have mentioned, we are only trading direction, but you can trade spike. It depends on how the signal come. I will open cash 300 so that you see how it works on spike. Okay, so this is boom 1000. This is the crossing here. This is the crossing here. There's a crossing here. So we shall be placing our stop loss above the crossing, possibly a low, a nearest low. I'm sorry, high, because we are selling here. Then let's mark the entry, break of structure. Before you talk about break of structure, most times the way you reason break of structure will vary depending on the market pattern. Trading is like playing football. If you understand what your opponent is playing, you can know how to tackle. So here, the market is actually flowing in a parallel and not in a vertical plane, in a inclined parallel. So there is a channel defined. So you wait for price to come near the channel, not break of structure anymore, because all the breaking of structure here didn't work. Price have to violate them and move against it to a channel. So here, you sell here, sell here. But there is one little break of structure that hold here. It's still good. Depending on the time you get the trade, you enter here. That is one here. But assuming you miss it and then you want to trade break of structure here, it doesn't make sense. Even though you later enter profit anyway, but um, uh, you lost a lot of potentials. You should have waited for it to come here and then you enter. That is by the way. Trading is full of emotions. It depends on how you enter, with the timing, how you control your emotion. Okay. Right now you are going to go to M15. Let's do this. You are entering somewhere here. You spot the breakout structure. So breakout structure happen here. Okay, happen here. So you mark this. The entry will be the stop loss here. Then entry will be in green color. Somewhere you are entering. After the retest, yeah, pullback. Okay, let's assume you are smart enough. You're entering here. We're entering here. Okay. So you go back to the lower time frame, 15 minutes. Go back, bring this. Let's bring the vertical boundaries, the two vertical lines. Okay, these are the two vertical lines we have. We can minimize more. Okay, the two vertical lines. Let's bring it. Let's bring it. Okay. Yeah, these are the vertical lines that are two here. Now, is there any low outside moving average 200, the green line, the green moving average, within this zone nearest to our entry? No, but we have this closer, right? So we measure. Since it's closer, we measure this from the entry. We're entering somewhere here. Measure it at 7 pip, and then do we have? Then what we are hedge for? What we are our hedge for stop loss is here. So we measure it down to the entry. Okay, so we have 137. So 137 plus 37 plus 37, 174 divided by 4, 87. So the average of 87 stop loss limit or pips is what you're gonna use here. So you come back here, come back here, come back here. Let's look. Okay, it's here. So you enter here, read 87, read 87, is around 87. This is it. You are going to place your stop here. 87. No matter how the price struggle, it won't reach there. Now, when you place 87, now remember we have $691, so you are going to divide it by 87. This time, oh my God, this is massive. The power of exponential, the power of exponential processes. You are going to be using 8 lot size this time around. Imagine 8 lot size, 8 lot size. This is crazy. Imagine this is H4, this is H4. You are going to target towards the end of this game. You are going to target towards the end of this game. You are getting over 827 pips. Imagine 827 pip times 8. You are now reading $6,000 plus. Like this is $6,616 in profit. This strategy can never fail. Okay, it can never fail. Okay, but this time around, I'm going to show you the exception. Make sure you stay to the end. You see, it takes a lot of time to generate this signal. Most time, there is what you call liquidity gap. Most time, moving average are lagging. This thing happens here because it has happened in the past. This is not real life. This thing has happened so back in the past. It does not mean it will not work for you. It will work for you. But if you need a signal in time, because it will take time. You imagine the time it will take. If you need signals in time, I don't know how I explain it. You need to use high level charting techniques to enter to get signal. If you're a day trader, if you are day trader or scalper, like you want signal daily, you don't want to be waiting. Then what you need is to join our VIP. I don't know how we explain it. Like you have to subscribe for our VIP. We have VIP Boom and Crash group, like VIP Boom and Crash, VIP Boom and Crash Indices expert group. Is only dedicated for boom and crash trading. We only serve boom and crash signal. They are simple. You say why not? Why am I spending money when I have already given out the knowledge? Yes, I give you the knowledge, but you see the exemptions here. Unless you want to be waiting for a long time to get the signal, but if you don't want that, you have to. You need a steady signal on the VIP to actually make steady income, a steady flow of money. Okay, or there are another way you apart from this indicator, since indicator have lagging behavior, if you really want to learn it the deep way, like other price actions techniques, demand and supply, the use of break of structural analysis, the use of liquidity grab, the use of smart money concept, other strategy that are combined together to generate signal without having lagging effect. Like you lead the market before it happens, then you have to enroll for our Boom and Crash Millionaire course. Okay, I'll be ending this video. Thank you for staying to the end. For you to stay to this point, it means you are ready to make it in life. Make sure you subscribe to this channel, turn on the bell notification if you haven't done that, comment, like, and so that YouTube will share this channel to a high level of audience. Okay, my channel is the only channel in the whole world that can change life. So refer your network to this channel. Simple. You will say I'm just joking. Let me tell you, I'm the only channel that have small view but high subscriber level. Imagine my video might have 20 view. A video might have 20 view for 1 month, but that 20 view will be a subscriber. That is the power. Why YouTube is not pushing it? Maybe brokers might be brokers might be afraid of my content, so YouTube might have this fear of pushing it higher to avoid some company being collapsed. There are a lot of magic in my game, so you have to do something for you to succeed here. Okay, so I don't know. You can decide to use the content and make it, but when you have gathered some money from it, in the long run, you will see failure. So you have to join our VIP so that all those lagging behavior. Do you think that trading community, trading platform developers just put indicator for you to reap the broadcast? No. Everything in trading is speculative. They have negative statistical edge. A lot of them have negative statistical edge, so that the brokers will be on the winning part while the traders will be losing. 99% traders lose, 1% win. I'll make it 10% win, 90% lose. WinFX trading existed to optimize all this, so we don't need to talk much. Leverage the effort of experts done for you services, and then add it to the little one you have. Then you have to you will not be among the 10% winner. Imagine you are among the 10% winner. Your life will never be the way it is. You stop losing. So what it is, 10% of the money you should have lost trading on your own, subscribe, use it to subscribe for VIP, and then also enroll for our Boom and Crash Millionaire course. The other courses anyway, but it depends on what you want. But I focus on, I emphasize Boom and Crash in this video because this is a Boom and Crash educational content. Thank you. Remain focused, remain successful, remain connected. Bye for now.